Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions are Nick Crail from F&B Wealth and Investments and Shane Watkins from All Weather Capital. Please send your questions to stockwatch@bdtv.co.za or via SMS on 41392. Shane, Nick, good evening to you both. Nick, if I may start with you tonight, it's not been a particularly good day on the JSE today, and the rand's come under quite a lot of pressure, and it's all quite interesting given what happened to the US markets on Friday, where the FT said they limped to an all-time high on the S&P 500. Do you get the sense that the wind is going out of the market sails right now?
I certainly get that feeling, yes. I think looking at valuations, I think uncertainty around political elections, trajectory of interest rates, so many uncertainties, I think, looking forward for the rest of this year, and yet we continue sort of limping through these all-time highs. For me, with that level of uncertainty, I think the wind is pretty much behind us.
Shane, I mean, what does it mean for you, and how do you position yourself for the year ahead? Or do you just take companies by their merits and maybe try and ignore some of the fairly significant amount of geopolitical noise all about us?
Hi, Julieta. Look, I think the reality is that coming into the end of 2023, the markets were discounting interest rate cuts in 2024. And, certainly big investment banks like Goldman Sachs indicated that those cuts might be front-end loaded. In other words, the first cut might even be in March. And financial markets are very much driven by what is the prevailing interest rate. That's the denominator in your valuation equation.
Yeah.
So to the extent that there were going to be rate cuts, you would see asset prices increase. The inflation picture's been a little bit more clouded of late, and perhaps those interest rate cuts that were initially anticipated to be in Q1 might be pushed out a little bit. And so I think the market's taking a breather. In any event, the spectacular rise we saw in the US market last year was really driven by 5 or 10 big tech shares. And, almost half of the S&P 500 last year, share prices were down. So it was quite a narrow market. And I mean, you're absolutely right. This year, the JSE has started off, I think the market's down 5%. So not the greatest start to the year.
Yeah. Just maybe both of you, before we get to questions, what is your view on when the first interest rate cut might occur? Nick, if you were a betting man, what month would you slot this divine intervention from the US Federal Reserve?
I think we should pick the day and perhaps the hour. No, I will be honest and say, I find it very interesting how markets have swayed. They number one, expected cuts during the course of last year, which never materialized. In fact, we had interest rate increases. And in my view, the only way you actually get to a interest rate cycle where we're starting to actually decrease interest rates is if there's a bit of an economic collapse. So, as Shane says, yes, with yields coming down, it should be good news for valuation. But if yields are coming down because the economy is really stagnating or actually going south, then it's not really going to do much for those valuations. I probably, at the moment, am in the camp that we're going to see higher interest rates for longer rather than imminent rate decreases. In terms of giving you the month, day, hour, minute, I'm not going to do that, but it ain't going to be any time too soon, is my view at the moment.
Fair enough. Such a spoil sports. Shane, are you with Nick there, that it may be later than everyone had hoped for towards the end of last year?
So, Julieta, there's an additional factor to consider that in 2024, a very large number of democracies have elections in the current year. As you know, definitively the US have elections in November, for example. There's even an election in Russia late in March. So South Africa, I think, will probably go to the polls in May, but I think nearly 20 countries have elections this year. And in an election year, there's always pressure on the central banks to cut rates to stimulate the economy so that the ruling party can retain their place, as the leaders. So, I think we've got to take into account that there will be some pressure on the Federal Reserve to cut rates. I always think that the most reliable guide is just looking at what the forward rate curves are telling you mathematically, and that will tell you what market consensus is among the bond market participants, who are probably the best people to judge this. And I mean, we're still looking at a rate cut in March in the United States of 25 basis points. And in South Africa, the forward curves are telling you the first cut will probably come in July.
Okay. Okay. So much for central bank independence. Okay, let's get on to questions now. And one of the shares that came under pressure today was Sasol. I'm not sure if it was because, if it was on the back of the AGM that they held on Friday, they put out the voting results today, and that normally doesn't really sway markets, and maybe some other factors there. But the question is, the viewer says, my Thungela, Sasol and Sibanye shares are horribly down and have been for some time. I realize commodities are cyclical and we are in a down cycle at the moment, although it feels like forever. Would I do better to sell them and make big losses and rather buy something like the S&P 500? Or should I hold on because the cycle will eventually turn and my losses will start to diminish? Would something like the S&P 500 not recover my losses before the next commodity upcycle? What do I do? Nick, what would you do?
Yeah, for me at the moment, I mean, it's a good question. It's quite a tough question, and I think overall, my sort of feeling at the moment is probably one of saying one should hold, and it's down to two areas. The first is, you're right, commodities, and specifically those companies that are perhaps a little bit more highly sort of geared to a commodity cycle, a little bit more speculative, have growth ambitions, at least with Sibanye, etc. They've come under a significant amount of pressure to the extent that I think all of them are showing value. The bigger question that you have is, when is that value going to turn? Now, if I was convinced that value was going to turn, during the course of the year or even sooner, I would be saying, increase. But I'm not quite there yet, so I wouldn't be buying any more. At the same stage, however, there is value. And so it's always a shame selling a value-orientated share with the idea that, next step is going to zero in the short term. You take somebody like Sasol as an example. I think their balance sheet is actually fine. So within that sort of environment, I don't think there's much risk that they're going to, go out of business, as it said. So there's a lot of value there. I think there's a lot of negatives and certain negative assumptions that have been sort of started to be baked into those share prices. And again, just have a look at Sasol. Let's talk about climate change and carbon emissions. I think that a lot of the fact that they probably are going to struggle to hit those sort of targets is now reflected in the share price, and that's why you've seen that company more than other sort of oil companies actually getting hit harder. But yeah, I suppose to answer the question, it's hold at the moment. I wouldn't be increasing the stake, and I certainly wouldn't be selling right now.
I mean, Shane, it would seem to be maybe just on a valuation perspective the wrong thing to do, to sell shares that are beaten up and then buy something that's quite expensive, i.e. the S&P 500.
So look, Julieta, we've had a decade and a half where buying shares because they're cheap hasn't been a great strategy. You're better off buying shares that are expensive that will become more expensive. The kind of narrative is buy high, sell higher. In this instance with Sasol, you've been buying low and it goes lower. Yeah, I'm a fund manager, not a financial advisor, but if I was a financial advisor, I would say this perhaps is a good opportunity to crystallize your tax losses, because the tax year end comes up in a month's time. So sell your losers now and crystallize that loss, which you can deduct. If you want to talk share specifics, I mean, look, the PGMs had an appalling year last year. Talking about the shares, they were down 50-60%. And they haven't started off this year very well, and that's because the platinum price is down 10 and the palladium price is down 15. So until those underlying commodities which they sell recover, they're going to have a problem. I mean, we've got 4 big PGM producers in SA, and at current prices, at least 2 of them are making significant cash flow losses.
Yeah.
And so eventually they're going to run out of money if the underlying commodities don't pick up. If I could just pivot to Sasol and say, Sasol is a company whose problems are largely of their own making. I don't think it's a very well-managed company. They've got very, very significant environmental problems, and a fair portion of their earnings are not in cash. So while it may look optically cheap on an earnings basis, the cash earnings are less than the accounting earnings. and that's going to have an impact on the dividend that the company can pay. And I think that there's a real risk that Sasol ends up, absent a massive rally in the oil price, it ends up what the environmentalists would call a stranded asset that no one really wants.
Yeah. The problem with Sasol also is that, it was a JP Morgan report, which you probably both read last week, that said they need to have, in their view, a much higher dividend to compensate shareholders for the cash flow risks. But the problem is that Sasol has got to spend a huge amount of money in order to decarbonize. So I just don't see how it can pay a higher dividend. So it's sort of stuck in this terrible conundrum where it can't pay shareholders out. I mean, if that's what they want in order to compensate them for the risk, because it needs that money to decarbonize. And if it doesn't decarbonize, no one's going to buy the thing anyway. So neither of you have mentioned Thungela. Nick, do you think Thungela had it was a brief moment and everyone thought, oh, Anglo-Americans are stupid, they shouldn't have unbundled it because of course the shares did what they did, they made a huge amount of money, but it was a very particular set of factors that contributed to the coal price rallying and Thungela's share price doing what it did, 2 and a bit years ago.
Well, exactly. I mean, number one, they managed to sell a lot of coal and then at the high price. What has sort of curtailed them in the last year is lower prices and obviously lower volumes that can go through ports, etc. So you both hit on both sort of sides. It was a spectacular rise from a share price where they got unbundled and where they actually got to. Do I see that on the table again? I probably don't see that on the table. I do think that was a certain sort of set of circumstance that kind of pushed us in that direction. But I do think that there's value, in these sort of commodities at the moment. As discussed, I mean, I prefer probably Thungela over a Sasol as an example in terms of buying right now. But certainly if the viewer has it, the question is whether you hold and crystallize that loss, or alternatively, whether you just hold and hope the cycle turns.
Yeah.
I'm probably more in that camp.
Yeah. And just lastly, Shane, I mean, you've set out your stall, as it were, but Thungela, do you have any particularly strong thoughts there?
Thungela is an exporter of thermal coal, and thermal coal prices have been relatively firm. They're having problems, with the Transnet transporting their coal to the Richards Bay terminal for export. But once they are able to get it to Richards Bay, there are already buyers for thermal coal, and the prices are quite high. At current prices, we think that Thungela should earn about 60 Rand a share. So, it's around a 3 PE. I think I would prefer Thungela to Sasol from these levels. I think it's a better managed business with a more obvious kind of cash flow profile. And while it has kind of similar environmental problems, they're not the same extent of the environmental problems that Sasol has. I mean, Sasol's problems are in some ways intractable in the sense that one of their main assets, or their main asset in South Africa, is Secunda, and Secunda is apparently the single most polluting site on Earth.
Yeah.
Secunda, according to the environmentalists, has more CO2 emissions than Portugal. So, I don't want to over-dramatize it, but it's clearly a very difficult problem to solve.
Yeah. Let's talk about retail stocks now. And there's a question that came through a little bit earlier saying, asking, what is the panel's view on Carp Agri for a buy and hold for a 5-year term? It seems that the group is still growing the assets and dividends are being paid. Intraday volumes are not very high, but might improve as assets grow over time. What do you think? Nick, what do you think of Carp Agri? It's quite an interesting company.
Yeah, so it's an interesting company. Lot of sort of changes in sort of ownership and I suppose disclosures, etc., more recently, as in over the last sort of 5-7 years. It is a company that I like. So fundamentally, I think it's actually quite well run. I think it's got opportunity set ahead of it. So on a longer term basis, I think there's some value. Obviously, anything that relies on rainfall, as an example, is difficult to predict exactly where that's going to be in a couple of years' time. So one's got to be comforted with the idea that you don't really know exactly how things are going to go. But as it sort of stands at the moment, I think with the opportunities that they have, I think it's a pretty good diversifier within one's portfolio.
Yeah, I mean, it's a crucial point about the health of the agricultural sector because some of their biggest customers are the farmers. Shane, but they're also, but I suppose it's not, it seems to be a slightly broader retail group than only one focused on the farming community. I mean, Agrimark is actually, you can get a fairly wide variety of goods at their stores, and then they've also got the fuel company. So, shops on petrol forecourts. Do you think that's a good part of the business? Because that has had a few question marks over it from a few analysts for the last couple of years.
Look, I think the forecourt business, which services largely the agricultural community, is a good quality business in the sense that it's environmentally quite hard to open a filling station. You need to go through a big EIA, and that's quite complicated. So there's a barrier to entry there. And so you're right, there's sort of two businesses. There's the forecourt business, which largely sells diesel into the agricultural community, and then there's their retail stores. I think both are reasonable quality businesses. It's a tiny company. It's got a market cap of about 3 billion. It's very much focused on the Western Cape. But I certainly think there are worse businesses out there if you want to go for a small cap opportunity.
Yeah, okay. My colleague at the Financial Mail, Mark Hossenfuss, loves Kaap Agri. He thinks it's one of the best run retail shares on the JSE. And on that note, Shane was telling us before we went on air tonight that there are a lot of retail updates that we need to look out for. Shane, I'll go back to you. But Nick, what are your thoughts towards the retail sector in South Africa this year? Do you think it's going to be another really tough one? I mean, does anything give you confidence that it'll be better than last year?
I think overall, I expect it to be better. I think just with the load shedding as an example, certain one-off costs that go through, understanding how to actually run a business through some of these sort of challenges, I think that kind of is behind them. So I think ultimately that's good. From a share price perspective, we've seen a rally off the lows that we saw probably around October, and in some cases quite a significant rally, and that makes me a little bit nervous. I would always prefer to be picking up the assets when I think they're very cheap, opposed to once they've run 20-30%. Overall, though, I do feel a little bit more optimistic than, let's say, this time last year on the retail side of things. Hopefully it's a better year.
Shane, what are you expecting? You told us before we went on air that we should be looking out for updates from Woolies, from Mr. Price, from Foschini. So quite a clutch of retailers this week. Or do you think they're going to be quite Truworths? Yeah.
So these will be updates for largely Christmas trading, and so up until the end of December. I think the general feedback will be that November was quite poor, and November, of course, incorporates Black Friday, but remember there was significant load shedding on Black Friday. So November, I think, will be poor, and I think December will be a little bit better. I think in totality, I don't expect any of the updates to be appallingly bad. I think that there will be, the way that the stock market works is that the results are responded to in relation to people's expectations.
Yes.
So if people expect results to be poor and they are even average, then you could see share prices go up. On the other hand, if you expect excellent results and they're merely good, the share price could go down.
Yeah.
So I think in totality, what I'm saying is I don't think there's significant downside in the retailers from here. Most of our retailers, in my opinion, are very good quality companies. They've got, good positions in the market. They've got decent returns on capital. Most of them have competent and experienced management teams. And as Nick said, leading into the second half of the year, we'll certainly have lower interest rates. And then we will probably have a lower load shedding burden. To put load shedding, or the cost of load shedding into perspective, Shoprite spends about $1.5 billion a year on diesel in periods of load shedding. This is a business that only makes $10 billion a year.
Yeah.
So, they could add 10% to earnings just by not spending the money on diesel. Even Pick n Pay, which has a lower burden, probably still spends 500 million rand a year on diesel. So lower interest rates and less of an impact of load shedding could see all of these companies report better results into the second half.
Certainly hope so. Nick, if you had to pick a retailer, would you go for the food groups or something a bit mixed? Woolworths gives you exposure to both, or would you go for the apparel retailers or furniture retailers? Where would you be prepared to fish?
I think apparel is quite a good sort of hedge. It's certainly an area that could hit hard, but ultimately I think one that can actually look forward to a somewhat better trading period in the next sort of, let's say, 12 months. In that environment, I would probably prefer a company like Mr. Price as an example, which I think has certain other external sort of factors, not only economic, tied to the local economy, but other sort of areas of growth for the group. So I like those sort of factors, and it also derated significantly last year. So I think it still actually remains quite cheap.
Shane, what about you?
I would probably pick Truworths. The reason that I like Truworths is I think it's an exceptionally well-managed business. Michael Mark, the CEO, has been there for over 30 years, and I think he's as good now as what he was the day he was appointed CEO. And the second thing that makes me like Truworths is the fact that the company is buying back shares. And we have a strong predisposition to favor companies where the company is doing a buyback. It means that there's always someone else alongside you buying shares in the market. And the other thing is, it gives you a good indication of how management are thinking about their business. If management don't want to do a buyback, you really have to question whether you should be buying those shares.
That's a good point. Didn't really think about it that way. And just a quick question, and a viewer sent it. It's a question for Jean-Pierre Verster, and I'm going to leave the bulk of it. But he asks, how does the Chinese economy look past their aging president? Well, Xi Jinping looks to me to be in there for the long haul, but the Chinese stock market is a horrible place to be. In fact, it's probably even worse than the South African stock market. I don't know if either of you have a view, Nick, on whether or not there's going to be any sort of respite for Chinese shares this year, or if the sell-off just is going to continue interminably.
Well, I think you mentioned it a little bit earlier in the program where you talked about significant geopolitical risks, and certainly the risk, I suppose, and the sort of pushback between China and the US, I suppose most of the West, that has been bad for local Chinese equity markets. I think Chinese equity markets at the moment are offering significant value at the moment. And probably globally, one of the highest levels of value that's out there. Your bigger question is, unless, I suppose my feeling is, unless the earnings become fantastic, the stock market has done so badly that most people are just happy to sit on the sidelines. The only thing that's actually going to get them interested going back, and I'm talking here specifically non-Chinese investors or offshore investors, would be if they almost can't afford to be left behind. We've seen that happen before with China, but I think with a lot of the sort of regulatory pressures, no one's interested at the moment. And, should that continue, I think this will remain a bit of a value trap. But on a longer term basis, and it could happen sooner rather than later, I think there is significant value there.
Okay.
But there's a lot of uncertainty.
Okay. Shane, I'll have to get your views on the Chinese market another time, but I'd rather get your stock pick this evening very quickly.
Sure. So maybe if I can combine my stock pick with my view on the Chinese stock market, because my stock pick is Naspers or Prosus, which are more or less the same company. And, I want to say that 2 years ago, I spoke at a conference when Naspers was 1,500, and I said that you're going to get a chance like this once in a decade to buy a company this cheap. And Naspers announced a restructuring. The share was up 100% within 3 months. And I think we have sort of almost an equivalent opportunity now because of how the Chinese stock market has performed. Remember, 75% of Naspers Prosus' NAV is a company called Tencent, which is in China but listed in Hong Kong. And the Chinese market performed appallingly last year. The median PE on the Chinese market, to give you a sense of how cheap it is now, is about 8. The global average is 16, and the PE on the Nasdaq is 38. So the Chinese market is very cheap. Tencent exists in the Chinese market, and Tencent was down nearly 50% over the last 12 months. Okay. That's despite Tencent growing its earnings, having significant cash flow, and when they're in the market buying back shares, they're buying back nearly $1 billion Hong Kong of shares a day.
Yeah.
So I think there are good reasons to like Tencent. And as I said, the main asset of Naspers and Prosus is Tencent. And you can buy Naspers on a 45% discount in net asset value and Prosus on a 35% discount in net asset value.
Okay.
So I think that's probably my best idea at the moment. You're buying a good company in China at a discount, and the main asset in China is extremely cheap.
Yeah. And then Nick, sorry, very quickly for you, your stock pick.
Very quickly, my stock pick is offshore. It's a payments company, Visa. I think the overall payment space is one that has been left behind by investors over the last couple of years. So you've seen a lot of post-COVID recovery in this sort of sector, and yet venture capital interest in that sort of sector, along with share price re-rating, hasn't really materialized yet. So I think there's a good opportunity the market starts sniffing and seeing the opportunity there, and that the stock re-rates. I think these are probably the most high quality kind of payments name out there. So that's my stock pick this evening.
Gents, thanks very much. Sorry to truncate you there. Nick Crail is from F&B Wealth and Investments. Shane Watkins is from All Weather Capital, and up next, The Close. Stay with us.